Welcome to the 2026 InTouch Live Speaker Series. My name is Jason Meshekow. I am the co-founder of InTouch Insurance and InTouch Live. I am here with our esteemed guest, the VP of Personal Insurance and Commercial for InTouch Insurance, Jenna Boiadjian. Jenna, thank you for coming out.
Thank you for having me. I'm excited.
You're welcome. You're welcome. You are sought after as far as an expert in this field. We had our event in the Skirball last November, and everyone was impressed by what you had to say, and they want to know what 2026 brings, so that's why you're here today. We are after the 1-year anniversary of the fires last year of Palisades and the Eaton fire, and I think the emergency order of the governor of California has expired. So we're going to get into what that means, and we're going to get into what Jenna's seeing on the personal insurance, not only from the auto standpoint, but for the home, and we'll get into a little, other areas regarding earthquake and flood and earth movement. So Jenna, what are you seeing out there?
I'm seeing insurance carriers are trying to literally run away from California. Already we didn't have such a big market to begin with. There's been a trend these last few years where California has been the pain in insurance carriers as far as the amount of claims that they have coming up, and we've been seeing a lot of carriers back down on writing new business for whether if it's commercial property, personal property, homes. And now that this order is off, it's like a green flag for the insurance companies to run away more quickly out of the state. What does this mean for us? It means we have less market to be more aggressive with, whereas before we could have shopped around for competitive quotes and rates, and now it's about finding the coverage we need. As you know, there's a lot of properties in construction are trying to get reconstructed from the fires, which what happened? It drove up the construction costs. One of the factors is, are you even insured enough? Do you even know how much it costs to rebuild your home? So these are all factors that take, in part of having the right coverage, having enough coverage, and at the end of the day, where to have coverage with.
And this time last year, we were all hands on deck and really turned the agency of InTouch 180 degrees around, because we were fielding not only claims, but working with our clients to go ahead and get, submit the claims and going from there. And now we're fast forward a year later, and it's a huge vacuum that's coming. One thing I think the biggest misconception is people hear admitted versus non-admitted. Like, oh, I'm with an admitted carrier, or I'm with a captive company, without going and confusing. Can you explain what those are? Because now, to your point, all the standard markets that, like, Mercury or Safeco or Liberty that we work with, Travelers, they're pulling out.
Yep.
And then they go to a Lloyd's of London based excess and surplus, which is not a standard market. Obviously you're seeing that. Obviously you're seeing, the rates going from there, and insureds are having sticker shock. So what are you seeing on the admitted versus non-admitted?
So first I want to give a little short example of what non-admitted and admitted are, because there are a lot of people, if you're not in the field, you're like, what is that? So admitted, think of it when there's a bank and the bank approves the first 250,000 FDIC approved, where the government will come in and, in a complete loss, they'll go ahead and reimburse you. So that's kind of the same analogy with an admitted market, where you kind of have the government coming in, backing the insurance company up if they were to go bankrupt and not able to pay the claims. Non-admitted is where you don't have that security. It's not government related, and it's all fully the insurance company. But a good thing is that We do have these insurance companies are all financially. It's public info, so there's a AM Best rating online. You could look up and you could see what rating
And
the
they're
insurance
solvent. That's the
company
biggest thing.
has. Yeah, so
Right.
like who are you giving your money to? Are they a reputable company? Are they able to handle a claim if there is a tragic, huge loss, where just like the Palisades, the whole city got burned down. So, and that's what we're seeing now. And to come talking about, even admitted company, which State Farm is an admitted company, but they do have different forms, and we talked about this during our seminar. And one of the policy papers that they have is actually a pool. And what this pool is once that monetary cap is out, then there's no money left in that pool. And we've seen people that lost all their homes, and they still actually haven't got paid out to rebuild their homes because either and then they have these other things where you have to rebuild on the same location. They're not paying you out if you're like, okay, well, the whole neighborhood is burnt down. I don't want to rebuild. I just want to move somewhere else and restart my life again. They're not paying out.
We, to piggyback on that, we have a client, and they're with State Farm. When the fires came down, you don't really know what you have as far as an agency until you do. And we had, I think, 107 claims that we filed, and over 30 plus structures that were
Total
losses. State Farm, you just don't know what you have until you do with them. And to this day, some of our clients have only gotten half of their money from State Farm, to your point.
Right.
And then they also taken in 2 or 3 public adjusters, architects, because they're forcing the insureds to say, okay, you need to give us papers as far as architecture blueprints to get the remaining part of your money, because we want to make sure that you're rebuilding. And here we are a year later, and they haven't gotten paid, to your point, because they're part of this exchange or this pooled program. So you don't really know what you have until you do.
Exactly, which brings to another topic. I actually met someone last week, and we were talking about he lives in the brush fire area. And it was a few years ago he got his home, and he only had the FAIR plan. And he had no idea that the FAIR plan only, and I'm only covers fire. It doesn't cover anything else, any type of peril. So with the FAIR plan, you do need another policy hand in hand with the same limits to cover everything else, any type of, whether if it's a water damage or
pipe breaking or
exactly, backup sewer, whatever it is. California FAIR plan only covers fire, and you don't know what you have until you need it. And then that's when we're like, well, I didn't know I needed a difference in conditions policy, guys. That's what it's called. So if you have a FAIR plan, make sure you have another policy that
The street name of that is called the wrap. Like, I have a wrap policy.
Right.
They don't know what the insurance lingo is, but they know they have a wrap on top of the FAIR plan.
Or a DIC.
Or a DIC. That's the difference in condition policy. We had so many clients that needed our direction, but we had a lot of clients where we had home offices that we did the business insurance. We didn't write the home because they were with the FAIR plan, or they were with State Farm or Farmers or whatnot. So here we are. We got through the year. We got to the 1 year anniversary. Now we're at the emergency order, which I don't think anybody in the news talked about, that it's expired.
No.
So now the vacuum comes, because now these carriers can really pull out and non-renew. Moving forward, the fire, having more fires, I would say, or additional fires in California or on the West Coast or in Southern California, has been kind of squashed from the recent rains. We had rains in November. We had the rains, torrential rains in California, and snow. around Christmas or Christmas Eve, all the way through New Year's, and now we're back in a dry period. So, as an insured or a homeowner, and what are your thoughts, or what kind of advice can you give to them as far as moving forward? Because their non-renewals might come because the emergency order has expired. The second thing is they might be getting a 30 to 40% rate increase. Or even higher.
Might is a very gentle word you're using.
Well, I'm trying to be gentle.
I think everyone wants to know the reality. There is a rate increase, and part of this rate increase is actually, aside from all these carriers having, I don't know I forget how much this Palisades and the Eaton Fire cost, but it was billions of dollars out of pocket.
I think State Farm blew through $8 billion of their reinsurance, which is the money they set aside for catastrophic claims, which is where we're at.
And so that's just one carrier.
That's just one carrier, yeah.
So aside from them trying to get all their money back with all these losses they had, a main factor is the cost of rebuilding these homes have significantly increased. Where before you could have rebuilt something just a few years ago, could have been maybe $500-600. Now you're talking in the thousands, at least $1,000 a square foot, if not more, depending on what kind of property you have, the area you're in. It's a major increase that you have to have in your limits, because the cost of construction is so much higher. So that's one of the reasons why the cost of insurance is driving up, because it just costs so much money to rebuild something.
Yep.
So that's one factor. You need to look out, I would say, if you don't get non-renewed, just do the math, look at your policy, look at what your limit is, and ask yourself, if I had a total loss, would this limit be enough to rebuild my home, or am I going to only rebuild the garage, So.
And that comes back to tolerating risk.
Yeah.
How much of the risk do you want to take on? Is it low, medium, or high, insuring for the whole house? Because a lot of folks can't absorb a 30% increase on their auto. A lot of folks can't absorb 30 to 40% increases on their home.
You're right.
And they're like, okay, well, if my house is 5,000 square feet, I only want to insure it for $600 a square foot. Okay, well, that's way under market price. Yeah. And if you have a custom home, or you've done a remodel and such, what's it going to take, and how do you tolerate risk in your head to go ahead and come up with a number? How much of that percentage, and this is what I advise my clients, or our clients, is to go ahead and say, how much do you want to take of it?
Yeah.
Because when folks are getting 30 to 40% increases, not only in their auto insurance, but for their home, or they get non-renewed, then they have to go to an excess and surplus or a non-standard market. So then you have to figure out where they're at. And, I tell everybody that I got phone calls over the weekend. I got my bill and my renewal, and it's 30% higher. I said, stay where you're at. Or we can get creative in trying to reduce the premium. But,
One of the creativities, which I usually sometimes suggest to our clients, is that it's the deductible. It doesn't make a lot of difference sometimes, but it still makes a difference. Before, when we would always look for, having a lower deductible, and, having a lower deductible where it's like, if you have a claim, you don't have to put so much out of your pocket.
Right.
The table has turned where if your damage isn't that big, if it's under $10,000 damage, you don't want to claim your insurance nowadays. My recommendation would be, pay for the damage out of pocket if it's something so minor, which brings to my next point is raise your deductibles, up to $5K, $10K. That's when you're going to see some premium relief just a little bit. You could do that. And then again, you have to sit down and do the calculation.
And that goes down to self-insuring. a certain portion of the risk.
Exactly. I mean, with even increasing the deductible, it's still self-insuring because now you're like, okay, well, anything under $10,000-$15,000, if anything happens, I'm not going to claim it to the insurance. Right. I'm going to self-fix this problem I have.
Yep.
And it's not, for stuff like that, minor fixes, I don't think it's even a good time to make a claim for minor things because in this type of market, a little measly claim that you could have just paid out of pocket, you're going to get surcharged for the next 3 to 5 years. The claim's is gonna be on your loss history. It's going to affect you. Yep. Whereas, nowadays it's like you don't even have a claim, but you're still seeing increases because it's the whole industry. It's not just you. It's how many claims
and it's not just
your
California,
neighbors had.
It's across the country.
Absolutely, but California is one of the worst out there. So.
Florida's not easy.
Texas, New York.
I mean, we're licensed in 38 states in touch, so we have clients across the country.
Yeah.
So let me get into the personal side. Let's get into the commercial for businesses. Are you seeing that seep over as far as the rate increases on the commercial side?
Absolutely. It's the same scenario, whether if it's a personal home or if it's a commercial property, whether if it's a warehouse, a shopping center, depending on the location, you're going to see an increase, some locations more than others.
And the construction type, too, is huge.
The construction type makes a huge difference. And another factor with the construction type is the age of the building.
Yeah, age and construction, yeah.
So, California was built not too long ago, but years have passed by where now we have a lot of buildings out there built into 1930s, 1940s, 1950s. If it's a wood frame especially, no sprinkler, it's time to do a renovation and get those sprinklers in there. That's actually another factor why carriers are non-renewing commercial properties.
Oh, because of the sprinklers and the age.
And not having sprinklers, it's an older age building. They're not into it. They're not interested. Especially if it's like a restaurant or something like that, you're done. They're kicked you out.
And then you have to go to an excess and surplus to get that.
Exactly.
An E&S market, like a Lloyd's in London. And then a lot of these carriers are now pivoting. I mean, yesterday I was at a post-holiday party, and someone in the party told me, oh, I heard that a lot of these standard companies now are having an excess and surplus, a non-standard portion of their business. I said, well, that's been going on for a long time.
Yeah.
You just don't know it because you had a standard thing and now they're putting you into the non-standard.
You don't know it until you're affected.
Yeah, right.
That's the thing.
Yeah.
So.
Interesting. Okay, so let's take a big 10,000 foot approach moving forward 6 months. What do you think by the middle of this year the personal market's going to be for auto and for home? And then we'll get into the other factors like the difference in condition or earth movement or flooding, because I had a client during the rains that Southern California had over Christmas, and they had 4 or 5 inches of water in the house and this and that, and they said, we want to file a claim. And I said, okay, not so fast, just stop for a second. What is the damage you have? Well, we don't have anything in the house, but it's under the water. I mean, the water's under the house. I said, well, that's not going to trigger a claim. Do you want earth movement? Do you want flooding? Because that's if water under your house continues and you're not pumping it out and goes into your house, your regular homeowners policy is not going to cover that.
No,
you need a
it's
difference
not.
in condition. So the rains are going to come back again on the West Coast, probably in February. What are you seeing in 6 months, you think? And then now that the floods are coming, it's like feast or famine. How are they going to go ahead, and are they going to tolerate that risk, or do your clients really understand it? What are you talking, or what are you seeing the market's going to be, not only from the homeowner side and the emergency order expiring, but from other perils?
I see a lot of mail coming in, so definitely check your mail.
Okay.
The mail is going to consist of non-renewals where they're coming off the risk. And another huge factor that people don't know, that it's actually something very important, is these little questionnaires that the insurance companies have started to recently send out. So these questionnaires, I would say, I started seeing it. I mean, I've been in the industry for 17 years, but now it's like consistent for the last 2 years. And you think like, oh, it's just, it's nothing. They're asking a question, nothing that says urgent or something. But it's a few questions. You don't answer them. Guess what happens? The next mail you're getting is a non-renewal because you didn't answer our question, our updates, questionnaires. So.
And then you get the phone call.
I get the phone call.
They're like, would you check your mail? And the biggest misconception is that as a risk manager or a broker, we know everything that's going on with the insured and the carrier. We don't.
We don't.
They are sending it directly, and they're not collecting $200 and passing go. We don't know. So then they call you, and then what happens?
Exactly. So the carriers don't send us an email. They don't send us the same letter, the questionnaire you get. And the next phone call we get is, I'm getting a non-renewal letter or, a cancellation intent letter. Can you look into it? So that's when I always discovered, well, you got this in the mail, this in this date, and you didn't answer it. And here we are. So hopefully, when that happens, if there's enough time before the cancellation date, we can get it answered, submitted, and they'll go ahead and, rescind the cancellation or intent of non-renewal or whatever it is. But it's crucial to keep your eye out on the mail. This year, anticipate getting mails, from USPS.
From your carriers.
Yeah, from your carriers.
And some of them, like a captive company, which is like AAA or State Farm or Farmers, they have nothing to do with an independent brokerage like us, so they go directly to the insured, and they can only write with their carrier that they're an agent of. So we're not touching those policies or quotes, but at the end of the day, it's going to happen. They're going to get stuff in the mail. They're not going to see it. You're going to try to rescind it, and the carrier is probably going to say no. And then it's like, okay, so now we got to go to an excess and surplus carrier, a non-standard carrier, because ultimately they're going to force everybody to do that.
Absolutely. So yeah, definitely don't ignore any mails. I'd say that's really the starting point with whatever's going to happen with your renewal this year. It's going to be in the mail.
And they're going to ask, what type of questions are they going to be asking?
Some of the questions they ask, it's either related with the roof, if there's been any renovations, and the electric panels are a hot topic. So there's a few electric panels 0 carriers want to be a part of. And I think it's safe to say some of the name brands of these electric panels is,
there's a list that the carriers have, and to go ahead and talk about which carriers which would be, I would say tough to do, because one carrier might say one thing, another carrier might say another thing, and they might accept it.
Right.
And it comes to underwriting. But the questions that they'll be getting in the mail are pretty much updates. And you're talking about the roof. The electric panel is one thing. The roof. There's carriers, and you guys out there listening to this, all of our followers and our friends and our partners, they have drones that they're going over people's homes, and they are inspecting the roofs.
Yep.
And seeing, especially now that it's raining, and then now it's dry for about 3 weeks, and then the rain will come back, they will be putting drones on roofs to see if there's algae or buildup of debris. And if there are, you're going to get something in the mail. And
exactly.
And it's, unfortunately, it's a game that we try to get in front of, and we don't have any control over it. The only thing we can do is advise, and this is why we're doing this podcast, because the education out there and for people need to be on high alert for what they're getting in the mail.
And I love how advanced these insurance companies are also getting too, because before, they would use like Google images
Yeah, right. Yep.
to see what they can see. But now they have their own wonderful drones flying over your backyard, flying over your roof. And then you get an aerial picture email like, oh, okay, we're gonna non-renew your client because look at the algae and the mold they have on top.
Especially, we had a lot of rain in November.
Yeah.
On the West Coast, and then you look at the East Coast, cold, pipes are cracking. You got the polar vortex. I was out there for 3 weeks practically in December and January, and it didn't go above 32 degrees. Not a heck of a lot of snow, but a lot of ice and a lot of light snow. And again, different perils, different conditions, harsher environments, still the same insurance problem.
Exactly.
Anywhere you go around this country, the insurance problems basically. What do I do? Who can you go to? That type of thing. And then, you talk about 6 months, 9 months, these letters are going to come out. They're also going to squeeze, they meaning the insurance carriers, are going to, I would say, condense their agents as far as who can write with what based on how much volume of premium they have, who's been canceled, who's not, and then the claims. And that's really I would say, the 10,000 view of the insurance industry and trying to navigate these pitfalls. And it's a very, very tough. It's a tough environment, and it's really tough to go ahead and challenging to explain this to people because they get a 30% rate increase and they don't know what to do.
Right.
And at the end of the day, sometimes we're the bad guys, and then we got to go from there. But at the end of the day, we're trying to help them out. All right. So in 6 months, you think how many carriers do you think will really pull out of California within the next year? So if we're doing this podcast a year from now, or let's say in the fall of 26, what do you see? What do you see as far as the carriers, and then what do you see as far as the insureds mostly going to non-standard business?
I mean, already given the trend that we're in, we already have some of the major carriers haven't been writing new business in California, or haven't been accepting any new homes, and really they're just brushing off their book and trying to minimize what they have to eliminate their exposure. But I anticipate at least 30%. That would be my guesstimate of carriers moving out of California, if not more. But we are going to see at least 30 to 50% of whatever is admitted market turn into non-admitted market. And probably the admitted market would be in like very flat lands away from anything and everything.
But everything. Like in a big valley where the hills on both sides, unfortunately or fortunately, have been already burned or burn scar area.
Exactly. And that's another thing I've noticed too. Like somewhere that's already been burned and there's nothing more to burn, the carrier might be a little bit more lenient on giving that person a quote or coverage for that area.
They'll give them a quote, but they're going to put a wildfire deductible of like I've seen anywhere from $50,000 to $100,000 up to $250,000. So for those folks that are listening, that if you were in a burn scar area recently in the last couple of years, you most likely will be able to get coverage, but you might have a higher wildfire deductible, and that's really going deep as far as smoke and damage from the wildfire. You have to pay that huge deductible and to get coverage. And then my answer would be, well, it's already burned. So what else is there left to burn? A regular house fire, you're not going to have to go ahead and pay for that. If it's considered a wildfire, and we'll just go into California, the California Department of Forestry or Cal Fire, if they determine it's a wildfire, then that might trigger that deductible to be paid by the insured. On the flip side of it, if it's not and it's going from house to house and it's just a 3-alarm house fire, that would be a different deductible. But everybody's changing. Yeah. Every day is changing.
As far as change, and actually another point I want to, I as a broker and insured, for the first time ever, last year I got an email from my insurance carrier asking me to do an inspection.
Mm.
So this inspection, it was via email, clicked on a link, and literally it took a little over an hour. It prompted me which room to go in next,
Wow.
from the kitchen to the backyard to the water heater. And literally it asked to see every inch of my home.
Hmm.
And I uploaded videos, I uploaded pictures, and
Interesting.
once that got submitted, a month later I hear back from the carrier, and they almost wanted to non-renew me because I had one strap on my water heater as opposed to two. So
Huh.
I got that installed right away and submitted proof just not to get non-renewed. So that's happening too. That's totally new. First time I did it.
They're just. It sounds like. Well, not sounds like it is. The carriers are making everybody jump through hoops to keep their insurance.
Yeah, they want a lot of information.
They want a lot of information. So again, folks, that for those of you who are listening, you either have two choices. You got to look at your mail, stay where you are, play the game, give them the information, or you don't want to do that. Come to us or another broker that you work with, and get a non-standard, non-admitted carrier that will still put you through some hoops, but not as much.
Yeah.
But there's still hoops.
If the standard carrier is offering you coverage, stay with them.
And play the game as long as you
Exactly. Some of my recommendations would be, if for that 30% increase we're all expecting, increase your deductible.
Mm-hmm.
See what coverages you really need or maybe don't need. We can always help you and give you scenarios of what the coverages are if you have any questions with that. But other than that, keep your eye out for the non-renewal because they're coming out, and we have the market if you need the help. So just
look
saying.
at your email and look at your mail. Really quickly before we end this podcast, because I think this is educational for everybody and affects everyone.
Absolutely.
Auto insurance. I know that's one of the biggest pain points for everybody because from 3, 4, 5 years ago, even before COVID, it's gone up 100, 250%, 1,000%. Someone told me this weekend that they had 1 point or 2 points, and it went up 400%.
Yeah.
The trend is going up. Is that what you're? I mean, the trend is not your friend.
So the trend is not your friend. I could say the worst in auto insurance is literally LA County.
Yeah.
Outside of LA County, I believe it or not, like if it's like Ventura, Kern County, it's like half the price of what it costs to have auto insurance in the LA County. Unfortunately, there's not much leeway around it. Again, one of the things you could play around with is the deductible, self-insure more. But it's horrible because we have a lot of claims here in LA County, in California with the auto claims. Given our streets are flooded with cars.
And then every night at about 8, 9 o'clock at night, you see car chases. And then they call it, I mean, if you're back east listening to this, you got to come out and you got to watch the car chases because not only is it cringing as far as what goes on, it's every night, but they cause damage and the claims go up.
There was actually a high-speed pursuit that ended maybe about 1.5 miles away from my house last night.
Yeah,
so
sure, all the time.
It's the valley.
And then the claims keep going up. Unfortunately, I tell everyone,
drive safe.
You drive safe, but how do you tolerate risk? Some can go to, a captive company like a Geico, but you're not going to have windshield coverage. So if you're in a Tesla and you're going into Geico and you have a rock that goes to your windshield that costs $3,000 to repair, what are you going to do? So, I mean,
that's another thing. Like, with these captive companies, I'm not going to mention any names, but I do know of a company that takes about 2 to 3 to 4 hours just to get someone on the line. If you need to replace, add and delete vehicle driver, you literally need to wake up at like 6 a.m. in the morning, call them first thing, because I heard that's the, like, it takes like 30 to 45 minutes in the mornings at that time. But it really matters on, what you pay for is what you get. If you want to go to a company like that, yeah, they might have you might have a little bit more savings on the premium, but really, if your time is more valuable than that, then you might want to go with a more standard auto carrier and not those captive companies, because I do hear they are a pain.
Yeah. And
So,
imagine them paying out claims.
they're not. They're not.
It's the wild, wild west out there, folks, and we do our best to not only educate you through our speaker series, through InTouch Live, and to give you a perspective that's basically right on the front lines of what we're seeing with our clients and on the insurance side. So on behalf of InTouch Live, Jen, I want to thank you for
Thank you for having me. This was fun.
You're welcome. You're welcome. Anytime. We will probably do one later in the fall or later this year to see where we are as far as the vacuum that the emergency order and the fires have basically created. And it's a catastrophic event, not only from loss of life, loss of property, but the insurance and the risk management. And it's a very, very challenging world to navigate. So I want to thank you, and you have brought perspective and insight for that. And we look forward to you on your next podcast regarding personal cyber insurance, and that's really a hot topic. So that's another one that we're going to be dropping later this quarter. So look for that. But again, thank you very much. And thank you, the audience.
Thank you.
Have a
Thank you
good
for
day.
having me.
You're welcome.